afternoon, everyone. Jerry Jones, joined by John O'Hare from the O'Hare Wealth Management Team. Weekly update for February 13th, 2025. We hope the year is starting off well for you guys and it's a little warmer wherever you are. And I know it is where John is, but it's a little chilly and a little snowy here. I kind of like it. As always, send us your questions at service@oharewealth.com or 414-644-0060. As a reminder, markets will be closed and markets and O'Hare Wealth Management will be closed on Monday, February 17th for President's Day. So please keep note of that. Moving right into it, got a lot to unpack for you today. And first up, John, top of mind for a lot of people, especially over the last 2 weeks or so, what do the steel and aluminum tariffs mean to your market outlook?
It doesn't change much on our outlook. And I think although this gets a lot of press, very, very few people understand what this means to our economy and to prices. And to give you some ideas here is I was looking at statistics today. We import, and I think it's about 70 billion of steel and aluminum. But I looked up some facts today. The tariffs, if put in place as is, will increase the cost of what we're already importing by $11 billion. Now, I want that to sink in for a second. 11 billion sounds like a lot of money. We have a $31 trillion economy. So this is something like 0.033% of our economy. For fun, I did some math today. It turns out at 11 billion, that's about $33 a year per person in the United States. So when I hear some of the commentators talk about a huge increase in inflation and costs and all this other stuff, it's not nearly as much as you think. But it is disproportionate. It will hurt the industries that use a lot of those steel and aluminum. And guess who uses a lot of steel? Auto companies do. Aluminum, actually, one of the biggest users is beverage companies, the aluminum cans. And so that will increase costs on the cans. But the cost of an automobile could go up a few $100s based on this. Now, this doesn't always just work as an absolute one-to-one pass-through. The U.S. companies have capacity in steel to produce more. And how steel companies work, the more you produce, the more profit you make, because the incremental production costs you almost nothing. So they don't necessarily have to raise their prices. Aluminum, we're in a tougher spot. We don't make as much of that here. So some of those prices will be passed on. But a lot of times the manufacturers will eat part of it. Even the folks who ship stuff to us might eat part of the tariffs. Overall, the readings I did today, one of them was S&P Global Research. They're a pretty good firm. They saw a very, very minor change to inflation due to these imports. What does it really mean? Most of the steel and aluminum comes in from Canada and Mexico. So if you've been following what's going on here, the current administration really wants help on the southern border to stop the flow of illegal immigrants and stop the flow of fentanyl. If you don't know what fentanyl is, a lot of people die from it. He's looking for help there. And that's why he's postponed some of those tariffs with Mexico to give them time to work with us. So part of the end game is to get cooperation on the border. The same with Canada. They want some help up there. Now, that's not nearly the problem as on the southern border. But these are negotiating tools. Will it crash our economy? No, actually, it's the reverse. If we make more steel here, that increases our GDP. So the same report I looked at this morning gave our GDP might increase by 0.03%. So it's actually a net positive for that. So it really doesn't change our outlook for the market. We started this year saying after 2 very good years, it's going to be tough to make money in the market this year. That seems to be the case so far. The market's also expensive, especially on the Mag 7 or the large ones that have been driving the market. So far things are turning out as we thought. No, I think that's again. Do we like it? No. Is it going to end or alter our outlook? No.
Fantastic. Thank you, John. Moving on to question 2 for the week. What did this week's CPI report say? We've got some charts here to back you up.
Yeah, let's put the first one up. Yeah, the big thing here, it was slightly hotter or higher than expected, and coincidentally, the chairman of the Federal Reserve, Jay Powell, was speaking to Congress yesterday after the number came out, and his statement I think is very helpful. He said a string of good numbers do not necessarily change the Federal Reserve's thought process on lowering rates, nor does a string of bad numbers it change their direction on what they're going to do with rates. So he reiterated that this is a bumpy road. Not every quarter is going to be nice and smooth and step down. Now, we've been saying this for a year and a half. There's going to be some blips. If you look at the chart we put up there, year over year, inflation's up 2.9, all items right at the top there. The items less food and energy are up 3.4. That's still a little hotter than they want. They want this to get down towards 2.5 or less. Interestingly, if you look at all items, food and energy, and look down there, commodities were down, apparel was down, new vehicles were down, medical was only up 2. It's really the services less energy that were strong, and that was shelter and transportation. Transportation is used cars, it's flying on airplanes, things like that. That was stronger than expected. Shelter, by the way, up 5.4 year over year, was not what they wanted, but it was a big part of the increase. Shelter is almost 40% of the CPI. And it is a slow change, but I know most of you understand shelter is calculated by looking at past rent prices and looking at owner's equivalent rent, which means you had to rent your home back. What would you pay for it? Most of us don't rent our home back, and we have fixed mortgages. So the real impact to the economy is much lower than it looks like from the CPI. Again, I think this is more of a bump in the road. Let's look at the next chart, Jerry. Yeah, if we look at the long-term trend here, the 70s, that was really bad inflation. I grew up during that. That was very, very tough. It came down in the 80s, came down in the 90s, basically from early 90s through recently, it's averaged maybe 2.5%, 3%. We're back down at 3%. We're pretty much back down to where we've been the last 20 years, almost 30 years. So we'd like it a little lower, but that spike you see on the far right, that was the COVID spike. That was the supply constraints. We've worked all that off. It's very unlikely to go that high again. But if it's slow to go down, it'll give the Fed pause. And now the markets, I listened this morning to CNBC. Actually, I read it in the Wall Street as well, is that the markets have raised it to a 30% chance that the Fed will not cut any more in 2025. Now, before yesterday's number, it was a 20% chance. Now it's a 30% chance. What does that mean? There's still a 70% chance the Fed cuts rates this year. How many cuts is the question? But 70-30, you'd bet there's another rate cut coming this year, and maybe 2. But the numbers are bumpy. We'll see what happens. Just pop up the third chart. kind of help people understand what the CPI is. And again, this is the Consumer Price Index. This is not the Federal Reserve's favorite inflation number. Their favorite inflation number is the PCE, Personal Consumption Expenditures. And I think that comes out next month. But they like the personal consumption expenditures better because it's more flexible in how it reads inflation. But this is another number, and now I look at housing is 40, almost 45%, transportation is 17%. Again, buying used cars and things like that. But it gives you an idea where all these numbers come from and what they mean. We're not going to let this change our outlook either. Interest rates, I think we said at our market outlook that we didn't think the Fed would lower rates a lot this year, maybe go 25 basis points down 2 times, 3 times at the most. Right now, I think 2 times is still the target. And in this environment, next month we could get a better number. The PCE number could be better. Again, like the tariffs, it doesn't change our outlook. We still think if we're investing in bonds, we should stay on the shorter end of the maturities to avoid interest rate risk because we're getting paid well for the shorter end. And on stocks, we're not getting out of the market, but we think returns in the stock market after very good returns the last 2 years and the last 5 years will be muted. If we probably do single digits or less, another 15, 20% year just doesn't seem like it can happen. Now, by the way, never say never, because I lived through the 90s .com bubble, and that market went a lot higher than anybody ever thought it could. So if people get excited, you can get what's called a melt up, where people get too excited, just keep buying whatever. I think there's still a 30% chance that could happen. But if we ended up the year up 5%, I'd be happy in the stock market. Could we be down 5%? Sure. But I don't see a scenario where we drop 15, 20, 25%. Because in 22, when the market fell that bad, it was because of the Fed rapidly raising interest rates. And that scared the heck out of everybody, and the market sold off. That's not going to happen again. And 2 years ago, you also had, almost 3 years ago, you had the Ukraine war break out and disrupt supplies of things. Well, if you listen to news this week, the new administration has already talked to Russia and Ukraine leaders, and they're trying to work on a solution there. So that war might be coming to an end, which is positive for inflation because, and we've already seen it, the news of that yesterday dropped oil prices 3%, because guess what? The Russians will be able to ship more oil again. The Ukrainians will be able to ship more food and grains and get them out of the country easier. Less money will go into unproductive defense spending, missiles and things like that. So these are all good things. Again, it's hard to find what would cause a significant decline in the market. So right now, based on our recent news, we're still pretty much in line with what we said in January.
All right. Thank you, John. Our last question for today. What did Chairman Powell say this week? I think you touched on it a little bit, so maybe just a wrap up of that.
Yeah, I guess I did kind of touch on it. He was in front of Congress Tuesday and Wednesday answering questions. And I think the most important comment he said is that one bad number doesn't change their outlook. They know it's bumpy. The other thing he did say to Congress, because I was listening to it yesterday, is he said employment is still very strong. I saw an interesting stat yesterday. Our unemployment rate is 4.0%. That's lower than it was all during the 70s, all during the 80s, and all during the 90s. So to give you an idea how low that is, in the 80s and 90s were very good economic market, and it never got that low. So when unemployment's that low, it means people are employed and they spend. So Powell's comments yesterday was he does not see a recession in the near future. And, we're on the same page with that. I don't think there was anything else to take away from that. Otherwise, it wasn't much different than we talked about recently.
Fantastic. Our continuing book recommendation for January and February, Proximity by Walcott and Krippendorf. Just a brief overview from you, John, on that.
Yes, what it means is everything is going to get to us faster and quicker. You think about clothes being made in Asia and then shipped for 6 weeks before we see them in stores. That will change. Manufacturing is going to move up everything. Food and every service. You already get instant service on your phone if you want to listen to music. We can get food delivered to our house. Now some of the stuff will be made to order, and it was fascinating listening to them or reading this book because we are speeding up everything that we can get to people. Proximity means it's what it says in the title: just-in-time transformation of business, society, and daily life. We're going to get everything we want quicker. And it's interesting to think about. Do we still have
for
a
that.
bonus book? Yes, our bonus book, The Blues Brothers. I threw this in because I read it, a friend recommended it. And this is the making of the Blues Brothers movie. It's more a biography of John Belushi and Dan Aykroyd. They set a record with that movie. They crashed 105 cars. There'd never been that many car crashes in any movie when they made it. The book is fun to read. It's a walk down memory lane for people my age group. I think you'll really enjoy this. This is just a fun book we threw in for this month.
Just like yesterday when I watched this first time. Well, thank you for joining us today. Once again, just a reminder, the offices and the markets are closed on Monday, the 17th. So please note that in your calendars accordingly. But on behalf of John and the rest of the O'Hare Wealth Management team, have a great weekend, and we look forward to chatting with you next week.
Thanks, everybody.